Welcome to Academic Gain Tutorials. In this video, we will look into the differences between bank guarantee and bond. A bank guarantee is defined as a guarantee provided by a lending institution under which the bank will assume the overall costs in case a borrower defaults on their liabilities or obligations. A bank guarantee is seen as a provision placed in the bank loan prior to them agreeing to provide the money. The bank will also charge a fee for providing the guarantee. On the other hand, bonds are used by various governments and corporations for raising money along with financing needed projects. An investor effectively lends a bond to the issuer at a certain time and receives coupon payments that are issued until the par value is repaid by the party that had borrowed the money. So, let's look into the basic differences between bank guarantee and bond in a tabular form. Difference number 1. A bank guarantee occurs when a lending institution stands as a guarantor and promises to cover any losses when the borrower fails to do so, whereas a bond is a deal or agreement between the borrower and lender that acts as a surety of the payment for either borrower or lender. Number 2. A bank guarantee gets issued only by a bank as a surety for certain individuals, whereas bonds get issued by the government, banks, or even large companies to meet their capital requirements. Number 3. The purpose of a bank guarantee is to guarantee payment if the borrower defaults, whereas bonds are used to raise money and finance projects. Number 4. The payment for a bank guarantee goes from seller to buyer via the bank, whereas the bank does not have to pay the bondholder and can keep the fees if there are payment issues. Number 5. A bank guarantee is seen as a liability for the bank because it is an obligation that the bank has to pay, whereas a bond is considered an asset like an insurance product. Number 6. Bank guarantees are used by individuals for international transactions to help businesses grow, whereas bonds are used by governments and corporations as they allow them to borrow huge sums of money. Number 7. Most bank guarantees charge a fee that is equal to a small percentage of the entire contract amount, normally 0.5% to 1.5% of the total guaranteed amount, whereas bonds involve coupon payments to bondholders. Number 8. Different kinds of guarantees include bid bond guarantees, performance guarantees, advance or deferred payment guarantees, and financial guarantees, whereas bonds are described as fixed income securities. Number 9. Bank guarantees are typically for specific contracts and periods, whereas bonds are issued with a maturity or end date. And finally, difference number 10. Bank guarantees are not typically traded, whereas bonds can be publicly traded or traded privately or over the counter, OTC. So, these are the differences between bank guarantee and bond. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.